Hey, Robert Oppenheimer here again. You can tell it's me because I'm wearing my genuine Stetson hat, which I bought in Tucson, and everybody knows I'm a cowboy at heart. When we were getting ready to test the world's first nuclear device down at the Trinity site, I told General Groves that once we started the nuclear reaction, there was a chance we'd burn up the atmosphere and destroy all life. He wasn't too happy with that, but about 15 years later, my worst nightmare came true. I'll never forget sitting down and looking at my black and white TV and watching the Soviet and American navies face off for about 13 days over the Cuban Missile Crisis. It's the closest the world has ever come to nuclear war. There's no doubt that some of Einstein's ideas have made this world a much riskier place, but it's even more true that his ideas have made it a better world. And when it comes to investing, I'm going to turn things over to my alter ego, Robert J. Schuman, the fiduciary investment advisor. Hello, Robert J. Schuman here. And if you give me a second, I'm going to share my screen and we're going to talk about from atom bomb to the perfect portfolio. Here we are, from atom bomb to perfect portfolio, part 2, measuring risk. How do you measure risk? We all know how to measure return. This is that map, that quantum map of all portfolios that I showed you last time. We all know how to measure return, which is on the left side of the universe of portfolios. But how do we measure risk at the bottom? No one really knew how to measure risk until 1952, that was about 6 or 7 years after the dropping of the atomic bomb. And it was when a young graduate student at the University of Chicago published his PhD thesis called Portfolio Selection. And he asked a simple question. He said, which stock is riskier? And he proposed that just as we can measure, that as physicists can measure the movement, the vibration of atoms and molecules and the range of vibration, that we can do the same with stocks. On the left is stock A, which has an expected return. That means over the long haul, the return's about to be 10%, 20% a year. But if the standard deviation, the volatility, the vibration is about plus or minus 40%, it's a high risk. It's a heart attack stock. In other words, you got to be willing to lose 40%, 2 out of every 3 years. Stock B, on the other hand, has an expected return of about 10%, but its variability, its standard deviation is plus or minus 20%. So there's an old saying, if you want to manage something, you have to measure it, or you can't control what you can't count. So Markowitz also then proposed that this is how we can, once we know how to measure risk, this is how we can manage it or control it. So here's 3 portfolios. So tell me, which one would you select? Remember, that was the title of his thesis, portfolio selection. Portfolio 1 has 2 heart attack stocks, Exxon Oil and Shell Oil, but they're perfectly positively correlated, meaning when one goes up 10%, the other goes up 10%. And you can see that the portfolio goes up 10%. However, portfolio 2 has 2 perfectly negative correlated stocks. Let's say Exxon Oil and United Airlines. When oil prices go up, oil companies their stock price goes up, but we can assume that airline stock goes down because their profit margins go down. So we call this perfect diversification, perfect negative correlation. It's why diversification is called the only free lunch in investment. You can control the risk. But in reality, there are no perfectly negatively correlated securities. It's somewhere in between. And so diversification reduces risk, but it doesn't eliminate it. But now we've got math. And now that we've got Markowitz's arithmetic, scientists, economists, money managers, academics could do some testing. And this is the famous Brimson-Hood-Biebauer study in which a couple of academics and investment managers asked the question, what determines portfolio risk? And they plugged in the capital asset pricing model. If you look on the right, you can see what are the 4 factors that they isolated that determine portfolio variability or risk. Asset allocation was 91.5% of the risk. Security selection, in other words, picking the stocks or the bonds, was only 4.6%. Other factors, 2.1%, and market timing, in other words, trying to get in and out of the market, was only 1.8%. And so this really marked the beginning of the end of what we call stock picking and set the stage for index funds and asset allocation. If you look at the literature, it's after Sharpe's paper that in the media, all of a sudden, everybody's talking about asset allocation. That was in the 1980s that it really started. So I want to acknowledge Harry Markowitz for this idea, the father of modern portfolio, who also shared in the Nobel Prize. Next week, we'll continue, and I'm going to actually take an example of portfolio and show you how we can control the risk and move it closer to the efficient frontier.